Alright, so hello everyone, and so far the first 2 weeks of 2023 has started on a pretty bullish note. As you can see, the S&P 500 is up over 4% for the year so far. Now, for those of you who are holding on to high quality businesses that are very profitable with free cash flow, you should be up even more than that. So you guys know that my portfolio was down last year, but so far it's been rebounding this year because, like I've said before, if you hold on to good companies, you have zero worries because what goes down will always go higher. Any drawdowns are purely temporary. So if you take a look at my portfolio right now, I'll show you two of my portfolios for the US markets. Right, so this portfolio over here, I just can show you my account performance year to date. There we are. All right, so year to date, it's up 9%. All right, at about 217,000 for this account, and for this other account over here, you can see year to date, it is up about 11%, right? And it's up $251,000. So in total, my two accounts, I'm up about over $460,000 just in the first 2 weeks. Now, granted, I'm still way below the high of my portfolio, which was the end of 2021, right up here. Because as you recall, last year, 2022, in the bear market, my portfolio was actually down 30%. Right, down 30% last year. So although it's up like 11% year to date so far this year, there's a lot more to do to get back to those highs up there. But it's okay because, again, drawdowns are temporary. They will always go back to new highs and new highs and new highs. But if you take a look at it in a longer time frame, you can see, for example, this chart I've just printed out is my portfolio from January 2019 to January 2023. So it's about 4 years. So like I said, as an investor, you got to take a longer term horizon of at least 3 to 5 years ahead. You can see in a 4-year period, my portfolio, which is the one in blue, it is still up 87.4% over 4 years, right? Even after this 30% decline last year. So once this bull market continues and the market rebounds, my portfolio will be up again, 150, 200, 300% and more as the years go by. Now, of course, the question on everyone's mind is this 2-week rally, just 2 weeks, is it sustainable or is it going to fail? Is it going to just, set us up for another rug pull and we're going to go through another leg down? Now, most people think that it is not sustainable. You know why? Recession is going to come. Earnings are going to crash. It's not going to be sustainable. And if you take a look at the charts over here, you can see that, yes, we closed back above the 200 moving average on the S&P daily candles, but you can see what happened. Every time it touched the 200-day, it went down, touched the 200-day, it went down, touched the 200-day, it went down, and we've got this really strong resistance trend line over there that we're going to hit, and we're going to go back down again. So what do I think? Well, I actually think that, there's a good chance that we are actually now starting a new bull market, that we will break this trend line and we will go to new highs. Maybe not this year, but over time. But I do think this is the start of a new bull market. Now you may say, why? Why do you think that way? Now, there are 3 signals of a new bull market, and I've been teaching this now for 18 years. It's not something new. So those of you who have been following me for many, many years on YouTube, on my live classes, you know this. I've been teaching this for a long time. There are 3 signals to a new bull market. Number 1, the first signal is that the market has to rise 20% from its lows. Now, that has not happened yet. The market's up only 14% from the lows. So that first signal is not valid, right? The second signal that a lot of people look at is when the market closes above the 200 moving average and the 200 moving average starts sloping upwards. Now, that has not happened yet as well. You can see that, although it closed above the 200-day, the 200-day was not sloping up. It's still sloping down. So that is not the confirmation of a bull market, right? Same thing over here. You can see it's closed above the 200-day, but the 200-day is still sloping down. So the second signal is not valid. But But the third signal is now valid. So you just need one of the three signals to confirm a bull market. So what's the third signal? What's the third signal? The third signal is something I've been teaching for, again, more than 18 years. And the third signal is this. When the 50 moving average, which is the blue line, when this 50 moving average blue line crosses above the 150 moving average green line, and both moving averages are flat or sloping up, that confirms the new bull market. So has that happened? Yes, it has actually just happened. So let me just show you this signal over here now. So let me just remove the 200 moving average so that it doesn't confuse you. Let me get rid of the 200. Okay, it's gone. Great. So all we're looking at now is the 50 in blue and the 150 in green. So again, as long as the 50 crosses above the 150 and they are both flat or sloping up, it's a new bull market confirmed. So you can see the 50 has crossed above the 150. Ta-da! But that's not enough. Is it sloping up and flat? Well, you can see the 50 moving average is sloping up, okay? And the 150 moving average was sloping down. You can see it was sloping down. But if you look at the last few days, it has started to flatten. So this is actually a valid signal of a new bull market. You say, really? Does this really work? Are you sure? Well, let me show you the history of this signal and how reliable it has been. All right, let's go back 20 years and look at this signal, shall we? Okay, so let's scroll back. Every time the 50 crossed above the 150 and they flatten or slope up, look at what happened to the market. It confirmed a new bull market, right? So let's go back over here to the COVID crash. Now, when did it cross? That was a crossover. Can you see that? Right, 50 crossing above the 150, blue sloping up, green flattened. All right, and boom, started the new bull market. Okay, let's go back even further. There, this one, same thing. Right, 50 crossing above the 150, right, and it begins to flatten over here, sloping up, and then triggers the next bull market over there. Let's go back even further, shall we? Okay. Now, this is not counted because it was not even in a bear market in the first place, right? So it's got to be first in a bear market, all right? Okay, how about this one? All right. So over here, you can see the market went into this was not really a bear market, but it was a big crash, right? Now, over here, you can see the 50 crossing above the 150. Now, is this a valid signal of a bull market? No. Why no? Because the 50 is sloping up, but the 150 is sloping down. So that was not a valid signal, and that's why it went back lower, right? Now, how about this one? Is this a valid signal? Yes, because the 50 is sloping up, and the 150 has also sloped up. So this is the valid signal. So the slope is the most important thing. It's not just a crossover, it must be the slope. And you can see that triggered that bull market over there. Okay, let's go back even further. Let's go back 20 years at least, right? To see the reliability of this signal. Is it really reliable? Okay, let's go back. There we are, right? 50 crossing above the 150. Right? Now, initially, this was sloping down here, so this was not the valid signal yet. It has to flatten. It flattened here, sloping up here. This would be the buy signal, all right? And then, boom. Then you start the new bull market over there. Okay? Okay, let's go back more. All right, how about this one? Same thing, 50 crossing above the 150. That's sloping up, boom. Next bull market's over there. Now, this was the financial crisis, right? So the market crashed over a year and a half, and then we had this bullish signal over here, right? 50 crossing above the 150, 50 sloping up. This was sloping down, began to flatten over here. So the buy signal, or rather the bull market signal, basically appeared somewhere here, and that triggered the next multi-year bull market, okay? So this 2008, 2009. So let's go back even further, right? I said, let's go back 20 years, man, 20 years, right? Okay. Now over here, now this was not a bear market in the first place, so that's not counted. In fact, this started the bear market. The bear market started over here when it crossed over, right? 50 crossing back below 150. Okay. This was not really a bear market as well. It was just a big crash. We can see crossover over there, and then bull market continues. Right? Now, this was again not a bear market because the 150 was sloping up all the way. It never sloped down. Okay, now this was a bear market. Yeah, this was the 2000 crash. Check this out. So the 2000 bear market actually started here. As you can see, this was an uptrend and it reversed into a downtrend. And you can see clearly the 50 moving average crossed below the 150, confirming the bear market. So where did we get a bull market signal during the dot-com crash? Now, over here, you can see that the 50 moving average crossed above the 150. So was that a bull market signal? No, because the 150 again was still sloping downwards. We need both of them to flatten or slope up. Now, you could argue that, well, over here, the 50 moving average did start to flatten and slope up. And the 150 did start to flatten. So this could have been actually a bull market signal based on that, that indicator, right? But then it failed. So in other words, this was a false signal. So again, no matter what indicator we use, it's never going to be 100%. There's no 100% indicator, right? So sometimes you do get false signals. Oh, that was a false signal over there. Then the market continued going down. And now, was this a bull market signal? Now, this is clearly not, because the 150 is still sloping downwards, never flattened, right? So that was not. And then we got another bull market signal, right? So 50 crossing above 150, that's sloping up, that's sloping up. Both are sloping up. So that would have been a confirmed bull market signal there. And that would have been the eventual bull market that started. So again, the lesson to learn is that there's no indicator that will give you 100%. All right, it's no such thing. You will get false signals. But you can see that this particular indicator I've been using for many, many years, it's not 100%, but it's over a 90% reliability. Over 90%, okay? So the fact that we now have this bull market signal, okay, tells me that there is a 90% chance that the bull market has started. Now you may say, Adam, I don't want 90%. I want 99%. Okay, fine. So if you want a 99% confirmation, I would say then wait for the second signal, which is wait for the 200 moving average, which is this red line. Wait for the 200 moving average to start sloping upwards. So when, or if and when, this red line 200 starts to slope upwards, it has to slope upwards, and we are able to break above this trendline resistance, then that I would say would be a 99% confirmation. Let me say, but I want 100%. Okay, great. So if you want 100%, then you have to wait for the market to close 20% below the lows. From the lows, sorry, right? So from the lows, you can see that we made in October last year, those were the lows. So far, we are up 14.4%. So it has to go up 20% and close above 20%, which is roughly at about 4,200 points to have the 100% confirmation. Okay, so notice that, you know, the higher the probability, right? If you want 100%, then you will have to end up, of course, buying in at much higher prices. There's always a price to pay, okay? Now, for me, if you ask me as an investor, you know, I don't wait for 100%. You know, as long as I got like, 80%, I'll start buying. Why? Because, I want to get in while things are still cheap, where they're still reasonably priced. When it's like 100% and everyone's sure it's a bull market, by that time things are bloody expensive again, But people say, but Adam, what if you're wrong? What if you go in with an 80% or 90% chance, but it's that 10% it goes down again? Well, so what? It goes down again, because eventually it will go up. Maybe later, maybe the bull market will start next year. Who knows, right? But as an investor, I'm patient. It's not a sprint that it must go up now. It's a marathon. I know it will go up eventually, whether this year or next year or 3 years, and I will get richer and richer over time. So I'm patient, right? So being a patient guy, I want to buy as cheap as possible, and that's why, in fact, I've already been buying as of last year, right? Even though we did not even confirm this signal, I was already buying, and you guys in my community be getting my buy signals. I've been adding more and more shares of great companies, and that's why I'm already up about 9 to 11% this year. Now, a lot of people say, but Adam, you can't just look at technicals, right? You just can't look at chart patterns. You have to look at the fundamentals, okay? So ultimately, a lot of people think that the market is going to go lower because corporate earnings are going to be worse than expected. People are too optimistic about corporate earnings. People believe that corporate earnings will decline even more, and corporate earnings have not yet bottomed. And you know something? I agree. They have not yet bottomed. I think that corporate earnings could still go down a lot more this year. They could. But you know what? Who cares? Let me show you why the stock market can still go up even if corporate earnings continue going down. So first, take a look at this chart. You can see this is the chart of the S&P 500 earnings per share. And earnings per share is still growing year on year. As you can see, the last quarter, it's up 6% year on year. So it's still growing year on year, although it's been decelerating. But month on month, corporate earnings have actually started declining. All right. And again, a lot of people expect that this year, especially if there's a recession, corporate earnings will go down even more and bottom only to the end of the year. All right. Now I'm going to show you something really interesting. If you look at all the past bear markets, you will notice that the stock market bottoms way before corporate earnings bottom. In other words, the stock market can go up even though corporate earnings are still in decline. Let's look at all the past recessions. Let me kind of like zoom in. So this was back in 1957, right? Let's go back to 1957. Now, pay attention to two lines. The first line is this dotted line. Can you see this dotted line in kind of like, is this blue or I don't know what you call that, right? Anyway, so this is the S&P 500, the stock market, okay? The second line to look at would be this red line. The red line are corporate earnings of the S&P 500, okay? So notice something interesting. Notice that the market bottomed here, right? But corporate earnings in red had not bottomed. They still continue going all the way down, and they only bottomed here. So notice that even as corporate earnings kept going down, companies reported worse and worse earnings, the stock market didn't give a flying fuck, right? The stock market went up, right? So if you say, Adam, I'm going to wait for corporate earnings to recover, to buy, by the time the corporate earnings recover, you'll be buying right here after the market has already moved like 50, 60% up. You're late to the party, okay? Now, let's look at the 1970s, which was the high inflation era that we can compare to right now. Same thing. When did the S&P 500 bottom? The S&P 500 bottomed over here, or over here. Let me see if I can use a drawing tool, right? Okay, so S&P 500 bottomed over here. Did earnings bottom? No. You can see that corporate earnings only started declining, right? And it went even lower, right? Earnings were declining, but as earnings were going down, the stock market was already going up. Now, the same thing in the 1980s. You can see that the market bottomed way before earnings bottomed. Market went up as earnings continued going down. Same thing in the 1990s. Market bottomed over here, and corporate earnings were still in decline. Corporate earnings bottom bottom a year later. Okay, so again, as corporate earnings are declining, the market's already going up. Because remember that the market is a forward pricing mechanism. The market doesn't care what's happening to corporate earnings today, what's happening to the economy today. It doesn't care. The market cares what it thinks the economy will be in the future. The market's always looking into the future. So that's why you have to look at leading indicators and not coincidence or lagging indicators. How about the global financial crisis? Same thing, market bottoms way before corporate earnings bottom. While earnings are going down, markets already starting to go up. Same thing with the COVID pandemic in 2020. Market bottom over there, corporate earnings bottom over there. It happened every single time. So I'm not too concerned if corporate earnings still go down, because that doesn't mean that the market can't start going up. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.